Hey everyone, in this video I wanted to highlight one growth stock that's down 91% that I think you might regret not buying on this dip. And that growth stock is Fiverr International. Now the stock price has fallen for several reasons. First, because investors feared that businesses would cut down spending on contract employee services because businesses were girding themselves for a recession. Then, after that worry, the investor community worried that Fiverr International would be severely hurt by the increasing effectiveness of artificial intelligence. So, combined, those factors brought down Fiverr International stock. It's down now 91% off its high, but in my opinion, that's an overreaction. I'm going to talk about a few financial metrics to explain why I think you might regret not buying this stock on the dip. So starting with revenue, you look at Fiverr's trailing 12-month revenue over the years, and the company's demonstrated steady growth. Even this year, when it forecasted revenue growth that was lower than projected, after the first quarter, Fiverr increased the annual growth target. After the second quarter, Fiverr increased the annual growth target again. And now it looks like for 2023, Fiverr is going to grow revenue by at least 5% for the year, when investors thought that there was going to be much less revenue growth at Fiverr. So that's one reason I think the company will continue growing, and next year should be a better year for Fiverr as businesses start to realize that the economy is not heading into a recession, or at least not into a severe recession, and so businesses could increase spending on services next year. The other reason I like to mention Fiverr stock as a growth stock to buy is because of the rapidly increasing operating profit margin. You could see this margin increasing over the years as it's grown its revenue. It reached negative 4.49%, and if Fiverr continues at the rate it's been growing lately, I wouldn't be surprised if its operating profitability turns positive in 2024. Now, I love the asset light business model. You've heard me on my channel talk about asset light business models as one of my favorite types of business models to invest in. And Fiverr is similar to those platforms I've been talking about, like eBay, Etsy, Airbnb, and others that don't own the inventory on the platform, right? Fiverr doesn't own the services that are being offered on the platform. Rather, it just brings together those that are offering services with businesses that want to purchase services, and Fiverr just takes a percentage from those transactions. I like those types of business models. I think they can be lucrative growth opportunities, and so that's why I'm suggesting Fiverr stock as a buy here. Finally, the last reason I'll give for why I think you might regret not buying Fiverr stock on this dip here is because of the cheap valuation. It's trading at a forward price to earnings of 13.63, the cheapest it's been in over a year and a half, and given its growth prospects, I think it's an incredible value at this price. So that's why I think Fiverr stock is one growth stock down 90 to 91% that you might regret not buying on this dip. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.